Hello and welcome to this video. In this video on financial analysis, I would like to analyze the working capital. For this video, I planned the following. First of all, I would like to go into the definition of working capital. What is working capital and how should it be? Then I would like to go into some measures, into some management ratios, like the days inventory outstanding, the days sales outstanding, and the days payables outstanding, with those wonderful abbreviations like DIO, DSO, and DPO. Putting that all together gives the cash conversion cycle, or also called operative cycle, which means how long does it take to convert cash into cash again, which is a measure of your operative excellence. Let's start. So, what is working capital? Working capital is current assets and current liabilities, both together. But adding them up does not make any sense, so the definition is, or it is better to say net working capital, because net working capital is defined as current assets minus current liabilities. Now the question is, how should net working capital be? Let me make some sketch notes on that. So, we need to differentiate between two possible outcomes. The first possible outcome is a positive net working capital. Okay, so a positive net working capital means that we have more current assets than current liabilities. So the left side is larger than the right side. This is what we see here. So there is a certain difference. I just write CA for current assets and CL for current liabilities. Now, what about the difference here? What is that? This means, since we have a difference here, which is the positive net working capital here, we need some funding for that, because we have more current assets to finance than we have current liabilities, so we will need some finance for that. I just write that down. Parts of the CA of the current assets must be financed by, and we have two possibilities to finance these assets. First, the first possibility is debt, of course, and debt is mainly interest-bearing. Or second, even worse than the first, equity, because equity is always expensive due to the expectations of the shareholders. So I just write expensive. Okay, so a positive net working capital is not very positive. It is rather bad for my company, right? So what about the negative net working capital? Negative net working capital means that we have more current liabilities than current assets, right? So here we have the current assets, and here we have the current liabilities. And there is a negative net working capital left here. So what about that? Here we have, oops. here we have some other assets. In other words, the current liabilities help with financing further assets like fixed assets. Parts of the current liabilities help financing. Fixed assets. And that's good, isn't it? But of course, since we know from other videos that I already made, we have something like a liquidity problem then. So how about liquidity? How do we measure liquidity? From another video we know about the cash ratio, the quick ratio, and the current ratio. Just write down the current ratio. And the current ratio is defined as current assets divided by current liabilities. And we learned that the current ratio should be approximately 1 to have a good liquidity status. If the current assets are underfunded, it is below 1, and that is exactly the case that we have when we have a negative net working capital, because then the current liabilities are larger than the current assets. Alright, so if we go too far into a negative net working capital, we will run into liquidity problems. How can we now manage the working capital? Let's have a look at that. The first thing I would like to manage is the inventory, which is part of the current assets. And the inventory, we see it here, contains raw material, so we have to purchase some raw material. From the raw material, we start producing our products. This is what we call work in progress. And as soon as those cars that we see here drive down the assembly line and are parked outside in the stock, we have some finished goods. And of course, after this process, we try to sell our cars. But these are the three parts that make up the inventory. Now, how long does this process take? How long does it take from the purchase of raw material to the sale of finished goods? Let's make some calculations on that. So, what I would like to calculate now is a ratio that is called Days Inventory Outstanding. So Days Inventory Outstanding, or abbreviated DIO. Okay, so what does that mean? It means how long does the production take from the purchase of raw material to the sale of a finished good, right? So how long does the production process take? The DIO is defined as DIO, and of course it's a ratio again, and the ratio is defined as inventory divided by cost of goods sold. Let us take a look at the units that we have here. So the inventory is of course measured in euro or dollar, but the cost of goods sold, typically one would say it's again euro, but it's euro per year. And if we now divide a number in euro by a number in euro per year, the whole fraction will give something like years. And thus we multiply it with 365 days so that we get something in days. Let's have a try. So where do we find the inventory? It is given here. And where do we find the cost of goods sold? That number is given here. So let's divide the inventory 5,265 by 3,365 times 365. And that is 1,56 years times 365. So, how does that come? Or just let me write down, it is 571 days. That's quite a lot. That's quite a lot for a production process. Nevertheless, why is that the case? And why do we make those calculations? So, the cost of goods sold are those costs that we have within 1 year. And the inventory are again the same, because if we purchase some raw material, that's the cost of goods sold, and we put that material into the inventory. So this is how much of that money is recently or currently captured in the inventory. How much of that amount is captured in the inventory. And we see here we have 1.65 years, that 156% of a year's cost of goods sold is captured. And that is 571 days. So the whole process from the purchase of raw material to the sale of goods is 571 days in this company. Can we somehow interpret these figures? Of course we can. First of all, of course, it's a calculation for the processing time. Then, of course, it is a measure of operative efficiency. If you look into the textbooks, you will also find alternative calculations. I just write down alternative calculation and follow those alternative calculation. The DIO is defined as inventory divided by sales. Okay, so often you will find in those textbooks DIO, DPO, and DSO all divided by sales. That is a certain consistency. Consistency to the other measures, but nevertheless here the numerator and the denominator are not consistent anymore. So no consistency. Between numerator and denominator, and we have a bias because it is too low, because the sales are typically too high. The inventory is measured in cost and not in market prices or sell prices, while the sales are measured in sales prices. So we have this inconsistency here, and we have a certain bias. So the consistency to DSO and DPO, if they are calculated the same way. So if you want to have consistency between all three measures, then you need to divide by sales. If you want to have consistency between numerator and denominator, you need to divide by cost of goods sold. Let's go over to the next step in our analysis. After the production process is over, the goods will be sold to customers and they will be invoiced. Or in other words, the company is waiting for the money. So, how long does the company wait for its money? That's the question here, and let's make some calculations on that. Alright, the calculation that I would like to introduce now is called Days Sales Outstanding. Or abbreviated DSO. So, Days Sales Outstanding, as the word says, is how long are we waiting for the money for our sales. The DSO is thus defined as accounts receivables divided by sales. Now, the accounts receivables, the unit is euro or dollar or whatsoever again, and the sales are euro per year again. So if we divide accounts receivables by sales, we will have a number in years. And if we multiply that by 365, we will have days. Where do we find the accounts receivables? We find them here. And the sales or net operating revenues we will find here. So we are dividing 7,199 by 8,694 times 365. That is 0.83 times 365, or equivalently 302 days. Again, a very large number. So here we see the result in years, which is 83% of a year, or of a year's sales, are captured in the accounts receivables. How can we now interpret the days sales outstanding? First of all, it's a measure of the market power on the sales market. Why that? Because if you have a strong market power, you can force your customers to pay early. If you have a low market power, you can not force your customers and you have to wait for the money longer. And additionally, it is a measure of the efficiency of the collections department. Why that? Because the collections department has to collect the money, and if they're working lousy, you will have to wait for the money for longer. There is no alternative calculation here. Because we already divide by sales, so there's no other alternative to that. We don't have consistency problems here. Now let us come to the last part of our working capital analysis. We are buying raw materials, like here we are buying tires on our own, and we have to pay the invoice for these raw materials. Invoices that are not paid yet are captured in the accounts payables. Now, the same question, but the other way around, or with a different sign. How long does it typically take us to pay the invoice? The measure that I would like to introduce now is called Days Payables Outstanding, of course. Or DPO. So, Days Payables Outstanding is the number of days, how long it takes us to pay our invoices that we have received. The DPO is defined as accounts payables in euro again, divided by the cost of goods sold. Because that's within 1 year, in the cost of goods sold are all costs that we have to pay, and the accounts payables are those that we haven't yet paid. So where do we find it? The accounts payables we will find here, and the cost of goods sold we will find here again. So, and of course we have to multiply by 365, of course. So we are dividing the accounts payables 11,312 by the cost of goods sold 3,365 and times 365, and that is 3.36 times 365, or equivalently 1,227 days. Wow, that is really long. That's 3.36 years until the payment of invoices on average. How can we now interpret this huge number here 1,227 days. That's really, really long. So 30 to 60 or even 90 days would be normal, but 1,227, that's quite a lot. Nevertheless, these are real numbers. How can we now interpret it as measure for market power? At the purchase market. And of course, there is an alternative calculation. So again, if you like, consistency among all these ratios, you can calculate the DPO by dividing by sales. So you would have to divide accounts payables by sales then. But again, accounts payables and cost of goods sold are the same, because they're both measured in cost, while sales are measured in sales prices. So sales are typically higher than the cost of goods sold, and then the DPO would be understated. Nevertheless, consistency between numerator and denominator is one thing. Consistency between DIO, DPO, DSO is the other thing. That's it. Okay, now the last question is, how long does it take to come from cash to cash again? So the whole circle here that we see. And there is one measure that we call the cash conversion cycle. And the cash conversion cycle, that is CCC, and it is defined as CCC is DIO. So the term, the money is stuck in the inventory, plus DSO. The term, the money is stuck in our customers. We're waiting for their payment. But we subtract DPO because that's the time we have the money, and we are not yet paying, right? So we have to deduct that, and we had 571. Sorry for that. Plus 302 minus 1,227, and that is minus 354 days. Is it good or is it bad? It is definitely good in this case because we have a negative number here, so we can interpret it as the lower the better. Why is that the case, that the lower the better? The lower the better is good because we're not waiting for our money so long, and our company is working quite efficiently. So we can use the cash conversion cycle as an operative measure of efficiency. In this case, we see that we have quite a lot of time to pay our invoices. So our suppliers help us financing the company. If we go back to our balance sheet, we see here that the current liabilities are larger, although it looks a bit different, but the current liabilities here are larger than the current assets. So in this particular case, indeed, the suppliers help us finance the company. We have a negative net working capital, and that means we are saving debt, and accordingly we don't have to pay interest, or we are saving equity and accordingly we don't have to pay a dividend on that. So that was it about the analysis of working capital. Thank you for listening. See you in the next video.